Most men come into the market believing action is the same thing as intelligence. I did too, once. They think if they are not in a trade, they are missing something. They think waiting is the same as losing. And when they sit flat, watching prices move without them, it gnaws at them like a bad debt. Have you ever felt that itch? That sense that the market is moving on without you? I learned the hard way that waiting feels like failure only to the man who doesn't yet understand how money is really made. The tape does not pay you for effort. It does not care how alert you feel, how busy you are, or how many trades you place. It pays you only when you are right, and only when you sit still long enough to let being right matter. Isn't it strange how difficult that simple truth is to live by? When you study charts long enough, you begin to notice that most price movement is noise. The market breathes in and out all day long, but real money is made only when it begins to walk in one direction with purpose. Yet most traders feel compelled to act on every twitch. They see a small rally and feel late. They see a dip and feel clever. And when nothing is clear, they feel useless. Do you see how that thinking traps you? Waiting exposes impatience. It exposes fear. When you're not in a trade, you're left alone with your thoughts, and that's uncomfortable for many men. They would rather lose a little money than sit with uncertainty. But the market punishes that habit relentlessly. Every unnecessary trade is a small confession that you don't trust your judgment or your preparation. Have you ever noticed how your worst trades often come from boredom rather than conviction? I never made my big money by trading all the time. I made it by waiting. I waited for the line of least resistance to reveal itself. I waited for the market to show its hand, and while I waited, I studied. I watched how prices behaved at old highs and lows. I watched volume swell when it mattered and dry up when it didn't. That waiting was not idle time. It was work, even if it didn't look like it from the outside. Isn't that the kind of work most people undervalue? The man who thinks waiting is failure usually measures success by activity. He counts trades instead of points. He counts days instead of trends. But the market doesn't reward activity, it rewards alignment. When price, volume, and general conditions line up, the trade almost places itself. Until then, your job is to do nothing. And doing nothing, when every nerve tells you to act, is one of the hardest skills a trader can learn. Have you ever asked yourself why stillness feels so expensive? There were long stretches when I sat on my hands while others bragged about their quick profits. I heard their stories in bucket shops and brokerage offices. Most of them were gone a year later. The market had taken back everything it gave them and more. My waiting kept me alive long enough to catch the real moves. That's the part no one likes to talk about. Survival comes before profit. Isn't survival the first rule of any serious business? Charts teach patience if you let them. A base takes time to form. Distribution takes time to show itself. Trends are born quietly and mature slowly. If you rush them, you end up buying tops and selling bottoms, all while telling yourself you're being decisive. But decisiveness without clarity is just recklessness dressed up as confidence. Have you noticed how the best-looking trades often appear boring at first? Waiting also protects your capital. And capital is your lifeblood. You can't compound money you've already lost. Every trade you don't take preserves your ability to act when the right one comes. That's not failure, that's discipline. The public never understands this. They admire boldness and speed. But the market favors restraint and timing. Why do you think the crowd is almost always on the wrong side at the wrong time? A trader's mindset is built in the quiet moments between trades. That's where you decide whether you are a speculator or a gambler. Gamblers need action. Speculators need confirmation. When you wait, you're telling yourself that your money deserves respect. You're saying you won't risk it just to feel involved. That kind of respect compounds over time, just like profits do. Isn't it interesting how self-control in trading mirrors self-control in every other form of wealth building? I've seen men abandon sound methods because waiting made them doubt themselves. They changed systems, indicators, brokers, anything to escape the discomfort of patience. But the discomfort wasn't the problem. It was the lesson. The market was trying to teach them to sit tight until conditions were right. They mistook that lesson for rejection. Have you ever walked away from a good plan just because it didn't immediately reward you? The tape moves in cycles. There are times to trade aggressively and times to trade scarcely at all. Knowing the difference is what separates the professional from the amateur. The amateur thinks every day must offer opportunity. The professional knows some days are meant only for observation. Observation sharpens judgment. Judgment preserves capital. Capital creates opportunity. That chain is never broken, no matter how modern the charts or how fast the data. Do you see how waiting fits into that chain? When you feel like waiting is failure, ask yourself what you're really afraid of. Are you afraid of missing out, or are you afraid of being alone with your discipline? The market will always be there tomorrow. Your capital might not. Every great trend I ever rode was still there after I had ample time to recognize it. The market does not reward the first man in, it rewards the man who stays in. And staying in requires that you enter correctly, which almost always means waiting longer than you want to. So when you're staring at the chart and nothing is clear, don't curse the quiet. Study it. Let it tell you what not to do. There is value in knowing when not to trade, even if it doesn't show up on your account statement today. That value accumulates invisibly, building the habits that make real profits possible later. Impatience shows up on the chart before it shows up in your account, and that's a fact every trader eventually pays for, one way or another. You can see it in the way price jumps too far, too fast, on thin volume. You can see it in the false breakouts that can't hold a level for more than a few bars. And if you're honest with yourself, you can see it in the trades you take, not because the market is ready, but because you are tired of waiting. Haven't you noticed how often the chart warns you before your account ever does? The market has a way of advertising human emotion long before it hands out the bill. When traders get impatient, they chase. When they chase, price stretches beyond its natural pace. That stretch leaves footprints. Gaps that don't belong. Candles that look excited but hollow. Moves that feel urgent but lack authority. A patient eye learns to recognize these signs, but an impatient mind explains them away. Do you ever catch yourself justifying a trade instead of observing it? Most traders believe losses come from bad luck or bad timing, but timing is nothing more than patience applied correctly. When impatience enters the picture, timing leaves. The trader stops listening to what the market is saying and starts arguing with it. He buys because he doesn't want to miss the move, not because the move is ready. The chart often shows this conflict clearly if you're willing to look. A resistance level that hasn't truly broken. A pullback that hasn't finished. Volume that hasn't confirmed. The warning is there, but impatience makes it easy to ignore. Have you ever seen a setup that felt almost right and taken it anyway? Impatience also distorts risk. When a trader is calm, risk is measured. Stops make sense. Position size stays reasonable. But when impatience takes over, everything tightens emotionally and loosens mechanically. Stops get closer because the trader wants to be right quickly. Size gets larger because he wants the trade to matter. The chart reflects this tension with whipsaws and reversals that seem sudden, but are actually quite logical. Price senses weak hands and shakes them loose. That's not the market being cruel. That's the market responding to pressure. Do you see how emotional urgency creates technical vulnerability? The interesting thing is that impatience rarely announces itself loudly. It creeps in quietly, disguised as confidence. A trader tells himself he's being decisive. He says he's trusting his instincts. But real instincts are built on long observation, not short discomfort. The chart often shows this difference. A patient trade tends to enter near balance, near support, near points where risk can be defined. An impatient trade enters in the middle of movement, where price is already extended and risk is vague. You can often tell which is which just by looking at the entry point. Have you ever looked back at a losing trade and realized the chart never really invited you in? Markets move in rhythms, not straight lines. Impatience ignores rhythm and demands immediacy, but charts are records of rhythm. They show pauses, consolidations, tests, failures, and retreats. When you rush these phases, you're fighting structure itself. A base that hasn't finished building will not support a sustained advance. A distribution zone that hasn't fully formed will not lead to a clean decline. These things take time, and the chart keeps score. The impatient trader treats time as an obstacle instead of information. Isn't that a costly misunderstanding? One of the clearest signs of impatience on a chart is inconsistency. Sudden reversals with no follow-through. Breakouts that fail within hours. Trends that can't hold higher lows or lower highs. These are not random events. They reflect a crowd that wants results now and doesn't have the conviction to stay. When you trade inside that environment without patience, you're swimming in emotional crosscurrents. The chart is telling you the crowd is undecided, but impatience convinces you that you must decide anyway. Why force clarity where none exists? Impatience also shortens memory. The trader forgets recent failures and focuses only on the possibility of the next win. The chart, however, remembers everything. It remembers where price was rejected. It remembers where volume surged and disappeared. It remembers where late buyers got trapped. When you ignore that memory, you repeat the same mistakes. Many traders lose money not because they don't know how to read charts, but because they don't give charts enough time to speak. Do you ever rush past important context just to get to a signal? There's a psychological cost to impatience that shows up technically as well. After a series of rushed trades, the trader becomes reactive. He starts anticipating moves instead of responding to them. The chart then becomes a canvas for projection instead of observation. Lines are drawn to justify entries, not to clarify structure. Indicators are tweaked to confirm feelings. This is impatience fully embedded in analysis. At that point, the chart stops being a guide and becomes an accomplice. Have you ever realized you were looking for agreement rather than truth? Patience, on the other hand, sharpens perception. When you wait, you notice how price behaves when it reaches a level, not just that it reaches it. You notice how volume reacts, how candles close, how momentum shifts or doesn't. These subtleties disappear when you're in a hurry. Impatience blurs detail, and detail is where edge lies. The chart rewards the trader who sees more, not the trader who acts faster. That reward doesn't come immediately, which is why so many men abandon patience just before it begins to pay. If you study enough charts, you'll see that big losses are often preceded by small warnings. A hesitation here, a failed follow-through there, a breakout that needs too much effort. These are early signs of impatience in the market itself. When the crowd pushes before conditions are ready, the move weakens. When you push with them, you share their fate. The chart is always honest about this, but honesty requires time to interpret. And time is exactly what impatience refuses to give. Flat days are tuition-free lessons if you pay attention, but most traders don't. They look at a day with no trades and think nothing happened. They close their charts feeling unproductive, even cheated. They wanted motion, and the market gave them stillness. But stillness is information, if you know how to read it. Have you ever noticed how uncomfortable a quiet market makes you feel? When price goes nowhere, it tells you something important about balance. Buyers and sellers are in agreement, at least for the moment. That agreement is not permanent, but it is real. And until it breaks, forcing a trade is like arguing with a scale that's perfectly level. Flat days show you where pressure is building and where it is absent. They show you which levels matter and which ones are being ignored. If you're paying attention, those are lessons you don't have to pay for with losses. Isn't it strange how traders complain about days that don't take their money? Most losses come from trading when the market is undecided. Flat days expose indecision clearly. Price tests a level and backs away. It drifts, it hesitates, it revisits the same range without commitment. This is the market saying, not yet. The impatient trader hears silence and mistakes it for opportunity. The patient trader hears silence and takes notes. One pays tuition. The other gets an education for free. Which one do you think survives longer? On flat days, charts teach you about context. You see how price behaves without momentum to hide its intentions. Small candles tell you about hesitation. Overlapping bars tell you about conflict. Volume that dries up tells you that no one is willing to press their bets. These are not boring details. They are the foundation of timing. A breakout that follows a flat day often carries more meaning because you've seen what happened before the move. But if you weren't watching, if you dismissed the day as useless, you missed that contrast. Have you ever realized too late that the quiet mattered more than the noise? Flat days also train discipline. They test whether you can respect your rules when nothing is happening. Anyone can follow a plan when the market is moving fast and rewarding decisiveness. But when nothing lines up, discipline feels like deprivation. You feel as if you're being denied progress. In reality, you're being protected. Every trade you don't take on a flat day is capital preserved and clarity maintained. That's not wasted time. That's risk management in its purest form. Do you value protection as much as you value profit? There's a financial mindset lesson hidden in flat days as well. Wealth is built not only by action, but by restraint. The same principle applies whether you're trading stocks or building long-term capital. Knowing when not to deploy money is just as important as knowing when to deploy it aggressively. Flat days remind you that cash is a position. They remind you that doing nothing is sometimes the most intelligent response available. Why is that so hard to accept when the evidence is right in front of you? Many traders feel the urge to make something happen. On flat days, they drop to lower time frames, loosen criteria, chase minor fluctuations. The chart doesn't improve when you do that, it just reveals your impatience more clearly. Instead of clarity, you get noise. Instead of structure, you get randomness. Flat days punish that behavior quickly, but often quietly. Small losses pile up, confidence erodes, and the trader blames the market for being dull, never realizing the lesson was offered without charge. Have you ever noticed how frustration increases when the market refuses to cooperate? Observation during flat days sharpens future execution. When you watch price fail to break a level repeatedly, you learn where real interest is lacking. When you see support hold without follow-through, you learn about weak demand. These insights don't trigger trades immediately, but they prepare you for when conditions change. The trader who pays attention on flat days recognizes the real move faster because he's already studied the boundaries. The trader who tuned out has to relearn everything under pressure. Which one do you think makes better decisions? Flat days also reveal your relationship with time. Trading is not a daily paycheck, it's an uneven business. Some days pay nothing. Some weeks pay nothing. Flat days force you to confront that reality. If you can't accept a day without trades, you'll eventually force trades where none exist, and forced trades always come with a bill. The market doesn't mind waiting. It's the trader who struggles. Isn't that an important imbalance to notice? There's also an emotional advantage to flat days. They give you space to reset. You can review past trades without the distraction of new signals. You can refine levels, clean charts, revisit assumptions. This kind of work doesn't feel exciting, but it compounds. Over time, it builds a calmer, more precise operator. The trader who only feels productive when clicking buttons never develops the depth. Flat days offer that depth freely. Do you take it, or do you rush past it? The market often transitions through flat periods before major moves. These periods are like coiled springs. Energy is stored, not released. Watching how price behaves in these zones teaches you where the spring is anchored. Breakouts that emerge from well-observed flat ranges are easier to trust because you've seen the struggle that preceded them. Without that observation, the breakout looks sudden and confusing. Flat days turn surprise into preparation, if you let them. Many traders talk about wanting consistency, but they reject the very days that create it. Flat days smooth emotional swings. They slow you down. They reduce overtrading. They remind you that your job is not to trade every day, but to trade well when the time comes. That reminder is priceless, yet it costs nothing. Still, most traders would rather gamble than wait. Have you ever questioned why excitement feels more valuable than clarity? If you learn to respect flat days, your trading changes quietly. You become less reactive. You stop needing the market to entertain you. You begin to see trading as a business of selection rather than participation. That shift doesn't show up immediately in profits, but it shows up in fewer mistakes. Fewer mistakes mean more capital intact. More capital means more opportunity when conditions finally align. Boredom is one of the most expensive emotions in trading, though few men recognize it while it's draining their accounts. Fear announces itself loudly. Greed is obvious once you know its shape. But boredom is quiet. It slips in when the market slows down, when price moves sideways, when nothing seems to be happening. And that's when traders start doing foolish things just to feel involved. Have you ever taken a trade not because it was good, but because you were tired of waiting? Boredom creates the illusion that time is being wasted. A trader watches the screen, sees candles forming without direction, and begins to feel unproductive. He confuses stillness with stagnation. The mind starts whispering that a small trade is better than no trade at all. The chart hasn't changed, but the trader has. That change is rarely for the better. The market didn't invite him in, yet he steps forward anyway. Do you see how boredom pushes you into the market instead of pulling you away from danger? Most bad trades don't come from excitement. They come from restlessness. When nothing is happening, the trader lowers his standards. A setup that would have been ignored yesterday suddenly looks good enough. A weak signal becomes a reason. A marginal level becomes support. The chart hasn't improved, but boredom has altered perception. This is how traders slowly train themselves to accept poor conditions. And once that habit forms, it doesn't stop when the market improves. Have you noticed how easy it becomes to rationalize mediocrity? Boredom also interferes with patience, which is the core asset of any speculator. Patience allows trends to develop, bases to form, and confirmations to appear. Boredom interrupts that process. It demands stimulation now. It wants movement, even if that movement is meaningless. Charts reflect this clearly. Instead of waiting for clean structure, the bored trader jumps into choppy ranges where price has no intention. He enters where probability is lowest and risk is highest. Then he blames volatility or randomness. Isn't it strange how boredom always finds someone else to blame? There's a financial cost to boredom that adds up quietly. One small loss here, another scratch trade there, a few commissions paid for nothing. None of these trades feel disastrous on their own. That's why boredom is so dangerous. It kills by inches, not by blows. Over time, it erodes confidence and capital, leaving the trader wondering why his account never seems to grow despite constant activity. The answer is rarely strategy. It's behavior. Specifically, behavior driven by the need to escape boredom. Have you ever totaled up what your dull trades really cost you? Boredom is closely tied to overtrading. When the market doesn't offer opportunity, the bored trader manufactures it. He trades smaller time frames, noisier patterns, weaker signals. He convinces himself he's being adaptable, when in reality he's being impatient. Adaptation improves results. Impatience degrades them. The chart tells the truth, but boredom makes the trader stop listening. He hears silence and mistakes it for rejection. Do you think the market owes you excitement? Professional traders learn to sit through boredom without reacting to it. They understand that boredom often means balance, and balance is a warning sign, not an invitation. When buyers and sellers are evenly matched, price drifts. That drift is not an opportunity, it's a pause. The bored trader sees emptiness. The professional sees preparation. One enters to feel something. The other waits to see something. Which one do you think keeps his capital intact? Boredom also exposes a misunderstanding about trading as work. Many traders believe working means trading. Clicking buttons feels like progress. Watching and waiting feels passive. But real work in trading often looks like inactivity. It looks like observation, note-taking, review, restraint. Boredom challenges this belief because it removes the illusion of effort. You're forced to sit with the reality that not every hour produces profit. That discomfort pushes many traders into unnecessary risk. Have you ever asked yourself why doing nothing feels harder than doing something wrong? There's a mindset shift that must happen if boredom is to lose its power. A trader has to stop seeking stimulation from the market and start seeking clarity. Clarity doesn't arrive on demand. It arrives when conditions align. Until then, boredom is simply a signal that patience is being tested. If you fail that test, the market charges you for it. If you pass, the reward is still having capital when clarity finally appears. That trade-off is always there, even if it isn't obvious in the moment. Charts often punish boredom immediately. You enter a dull range, price moves a little, then reverses. Stops are hit not because the idea was wrong, but because there was no idea at all. There was only a need to act. Over time, these trades create a sense that the market is hostile or unpredictable. In reality, the trader is the unpredictable one. Boredom makes execution sloppy and analysis shallow. It turns trading into entertainment rather than business. Do you treat your capital like money or like chips on a table? Boredom is also dangerous because it disguises itself as confidence. The trader says, "I've seen this before." He says, "I know how this usually goes." But usually is not always, and boredom makes the trader careless with that distinction. He stops waiting for confirmation because confirmation takes time. Time feels heavy when you're bored. The chart hasn't earned the trade, but the trader gives it one anyway. That generosity is rarely returned. The irony is that boredom often appears just before opportunity. Markets compress before they expand. Quiet periods precede movement. The trader who cannot tolerate boredom exits the stage just before the play begins. He wastes capital and energy during the dull part and has nothing left when the real move starts. That pattern repeats endlessly in trading accounts around the world. Have you ever missed a good trade because you were worn out by bad ones? Learning to sit with boredom changes your relationship with the market. You stop demanding action and start respecting timing. You become selective. You trade less but with more intent. That shift doesn't feel dramatic. It feels quiet. But quiet changes last longer than emotional bursts. The best trades feel obvious only after long periods of nothing. And that truth frustrates most traders because it refuses to reward impatience. When you look back at a clean trend or a textbook breakout, it seems simple, almost inevitable. You wonder why everyone didn't see it. But what memory edits out is the long stretch of dull price action that came before it. The waiting, the hesitation, the false starts. Have you noticed how hindsight deletes boredom but keeps profit? Before a good trade appears, the market usually does very little. It drifts. It tests levels without commitment. It moves just enough to tease interest, then pulls back into silence. During this phase, nothing looks obvious. In fact, everything looks questionable. That's why most traders are absent when the real move begins. They grew tired of watching nothing happen. They decided the market was broken or their method had stopped working. Isn't it interesting how clarity arrives only after patience has already done its job? Obvious trades are built quietly. A base forms while attention fades. Resistance weakens while volume dries up. Support holds repeatedly without reward. These are not exciting developments. They don't trigger alerts or adrenaline. They require observation without action. The trader who stays present during these periods starts to notice subtle changes. The way price stops falling. The way rallies go a little farther than before. The way sellers stop pressing. None of this screams opportunity, but it whispers preparation. Do you listen closely enough to hear it? Most traders want the signal without the weight. They want the arrow on the chart without the context behind it. But context is what makes the signal reliable. A breakout means little if you don't know what price has endured to reach that point. The long periods of nothing are where that story is written. Without reading it, the trade looks like a guess. With it, the trade feels obvious, but only in retrospect does that obviousness seem simple. Isn't that a dangerous illusion? The market has a habit of rewarding those who tolerate boredom with clarity. While others drift in and out, chasing minor moves, the patient trader accumulates understanding. He sees the boundaries of the range. He knows where price has failed and why. So when price finally moves with intent, he doesn't panic or hesitate. He recognizes the difference between motion and meaning. That recognition makes execution calm. Calm execution makes profits sustainable. Have you ever felt the difference between forcing a trade and recognizing one? The illusion of obviousness is strongest after the fact. Once a trend is underway, every prior hesitation looks like a gift that was ignored. But while you were living through it, that hesitation felt like uncertainty. That's the paradox traders struggle with. The market never announces when it's done being quiet. It simply stops being quiet. Those who endured the silence notice immediately. Those who left come rushing back late. Which group do you usually belong to? Long periods of nothing also filter out weak conviction. They expose whether you trust your process or merely tolerate it when it's exciting. Anyone can believe in a method during momentum. Belief during inactivity is rarer, but it's that belief that keeps you prepared. Prepared traders don't scramble when opportunity arrives. They act decisively because they've already done the waiting. The trade feels obvious because the work was done beforehand, not because the market suddenly became generous. Charts reflect this process clearly. Before a clean move, price often compresses. Ranges narrow. Volatility contracts, volume fades. These are signs most traders interpret as disinterest. In reality, they are signs of balance resolving itself. The trader who understands this doesn't grow bored, he grows attentive. He knows that something unresolved is being built. When resolution comes, it doesn't feel surprising. It feels earned. Have you ever entered a trade and felt calm instead of excited? The danger is mistaking obviousness for ease.